9.6% operating margin, 2.4 billion GAAP operating income, 2.7 billion GAAP net income, 3.1 billion non-GAAP net income, operating cash flow of 3.1 billion, free cash flow of a billion, 0.7 billion increase in our cash and investments quarter over quarter. Cybertruck factory tooling on track, producing RC4 builds, so release candidate 4 builds. Model Y became the best-selling vehicle globally in Q1. Okay, so let's sit down and see. So revenues came in at 24.9. GAAP gross margin is down by, let's see, 1.1%. From 19.3 to 18. Operating margin is also down from 11.4% to 9.6. Let's see. And I'm going to start putting these numbers into my Excel spreadsheet here shortly so we can actually look at this. EBITDA margin is actually up sequentially from 18.3% to 18.7%. Where's that coming from?
I'm seeing energy is actually down slightly quarter over quarter on revenues, which is a big surprise to me.
Okay. Yeah, 1529 to 1509. So slight. Services and other revenue is down by about 300 million. Let's see. All right. Let me go down to their breakout by, and make sure everybody can see this, right? Yeah. Okay. I want to make sure this is up on the screen. Let's look at what the stock is doing. Stock is down 1.3% in after hours right now. So not a huge down movement. But as we go through this deck, we'll be able to, where did it go? Here we go.
This looks pretty good on the surface.
Yeah, I agree. The earnings per share came in at 91 cents, adjusted earnings per share, which is pretty good. I'm trying to see if there was a big, like, where that beat's coming from. So I'm gonna keep digging into this.
Yeah, if you see anything in the comments, make sure you share it. Yeah, go ahead, Josh.
Still a $600 million negative foreign exchange impact again this quarter.
The nice thing is, like, reg credits are consistent at 567 million, which is, it was 564 in Q1. So, that's a nice indicator that it's not a low quality beat necessarily. It's not like they just, doubled their reg credits, because everyone likes to back those out. So I agree. I'm looking at this. I'm thinking this is actually like pretty good.
Yeah, free cash flow of a cool Billy. So total cash equivalents are 23.1 billion.
So even though their car gross margin is down sequentially, they were still able to generate more profit quarter over quarter, which is what helped them publish a higher net income quarter over quarter. I'm just trying to see. Yeah. So the operating leverage really is kicking in here is what we're taking away from this at just a first glance. Would you guys agree with that?
Yeah, 10%, close to 10% operating margin. And they actually talk about this. They say our operating margin remained healthy at approximately 10%, even with price reductions in Q1, Q2. This reflects our ongoing cost reduction efforts, the continued production ramp success in Berlin and Texas, and strong performance of our energy and services and other businesses.
There's also a $328 million plus on the other income line, Matt. Have you ever seen this number before?
Yeah, what is that?
What is that coming from? Interesting.
That's a good catch. Yeah, I mean, that's a big anomaly on that line.
Is that the one-time FSD impact, you think?
No, because that comes through automotive sales. It's possible, like, that could be, I don't know if that's where, like, Bitcoin would go. Like, if maybe they sold some of their Bitcoin holdings at a gain from where it had been marked. That's potential. I don't see that anywhere, though.
Okay.
Just a little quick theory. Digital assets net actually increased sequentially, so I don't think that would be the item.
Let's look at how. So the stock's actually up now 1.65% in after hours. So market seems to be liking this. Let me go ahead and read some of these pointers here on the screen. I'll try to make it as big as possible so y'all can read it with me. I do apologize if it's a little small. I'll try my best here. So total revenue grew 47% year over year in Q2 to 25 billion. Revenue was impacted by the following items. So growth in vehicle deliveries was positive. Growth in other parts of the business was positive. Reduced year over year, so that's average selling price year over year, excluding foreign exchange impact, was negative. And foreign exchange impact of 0.6 billion, so 600 million, was also negative. Our operating income decreased slightly year over year to 2.4 billion, resulting in a 9.6% operating margin. Year over year, operating income was primarily impacted by the following items. To reduce ASP, they're still calling that as a negative. Cost of production ramp of 4680 sales and other related charge, a negative. Income and operating expenses driven by Cybertruck, AI, and other large projects. I believe this is the first time we're getting this line on the earnings report. So an increase in operating expenses driven by Cybertruck, AI, and other large projects. Negative Forex, positive growth in deliveries, which we've covered. Lower cost per vehicle, which includes lower raw material costs and IRA credit. So did they call it the IRA credit before, Matt, or is this the first time?
I don't think they actually explicitly called it that. I can pull up the other one just to check, but that seems to be new language. Yeah, so they did not have IRA in Q1 letter. So that is definitely new language.
Gross profit growth in energy business as well as services and others. So they're calling out a gross profit growth in energy business. So we'll have to sit down and see what that looks like. And again, they're calling out mainly a free cash flow of $1 billion, partially offset by other financing activities, including debt repayments. And the cash equivalents and investments increased sequentially by 0.7 billion to 23.1. So they were still able to add cash to their balance sheet quarter over quarter. Let me go out to this Outlook page. On volume, we are planning to grow production as quickly as possible in alignment with the 50% compounded annual growth rate target we began guiding to in early 2021. In some years, we may grow faster and some we may grow slower, depending on a number of factors. For 2023, we expect to remain ahead of the long-term 50% CAGR with around 1.8 million vehicles for the year. Cash, we have ample liquidity to fund our product roadmap, long-term capacity expansion plans, and other expenses. Furthermore, we will manage the business such that we maintain a strong balance sheet during this uncertain period. So they're calling out an uncertain period, which I'm assuming is tied to potential recession fears and what the Fed's doing with interest rates. Profit. While we continue to execute on innovations to reduce the cost of manufacturing operations, over time we expect our hardware-related profits to be accompanied by an acceleration of AI software and fleet-based profits. Interesting language there. And product, Cybertruck remains on track to begin initial production later this year at Gigafactory, Texas. In addition, we continue to make progress on our next generation platform. So I'll pause there and see if anybody has any thoughts. I'm not sure if you guys were able to go in and dig up some numbers. I'm going to try to do that on my end. Does anyone have any thoughts they want to share while I try to do some math here?
Sure. If you go one page back, up, just up. Yeah, right there. Yeah, and yeah, go ahead, do your math. So the services and other businesses section is interesting. So they say the second quarter of 2023, or the second quarter has been the quarter of supercharging. A significant number of companies, including Ford, GM, Mercedes, Nissan, blah, 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 have adopted the North American charging standard. And then and they show the services and other gross margin graph, and they show that it's close to 10% now. Matt, do you know how much of a bottom line driver services currently is, and how much do you think it could be here? Not to put you on the spot, but
Yeah, I was looking at something else, but it has historically been pretty small, just because the base of numbers is pretty small to begin with. So I think last year or last quarter it was 135 million in gross profit, and so it's like the overall base that it's like 1.8 billion in revenue Q1. So like that, I do expect that will grow. But I have a hard time with that line, to be honest with you. Just like thinking about how many F-150 Lightnings and Rivians there are out there relative to the size of the Tesla fleet, it seems like it's relatively small to me. So for that to be like a big driver of revenue and eventually margin, seems like that would just take us like a slow burn. I think to me, the bigger thing on this side is like the sale price for the used vehicles that they sell, which especially when you consider that the cars coming off lease that they have coming through, that's where that line hits, the services line as well. So like all the initial Model 3s that were leased in 2019, 2020, I think 2020 is actually when they introduced it. Those are coming off lease now, so Tesla can sell them for a profit. But with used car prices down, that I think that's hurt a bit in Q2, I would think.
Hey, Farzad, can you go to the installed annual vehicle capacity?
What page is that? Oh, here?
Yep. Notice on the next gen platform on the left, it says various now. So that's confirmation. That's new.
Interesting. So it's not just a Mexico thing. It's going to be in multiple facilities. Good catch. Sorry, go ahead, please.
I was just going to say, I mean, I think we all knew that, but, it's nice to see it confirmed that they're looking at that various. I think there's rumors, in Austin as well. So I think it's exciting.
Real quick, the math I did. So even though energy was down sequentially, margins are up to 18.4% from 1% on energy. So it looks like in this quarter, they spent some time to maybe get their processes down pat, and they were able to raise their margins by about 4 basis points, roughly more, actually.
It could also be just the type of products that they were able to recognize the revenue on. So they have significantly increased the price of Megapack over the last couple quarters or years. Sorry, it was originally going for about $350 per kilowatt hour. Now it's more like $500 if you include installation, maybe $450 without. So it depends in any given quarter. If you're recognizing revenue from an older order, that was at that lower price point, that's going to have a big difference once you start rolling those off and you get to the higher price point, $500 per kilowatt hour Megapacks. So hopefully this is kind of like more like the new normal level, because I think I was not expecting 18% gross margins. It's actually funny. I was expecting a lot more revenue growth, but they actually had revenue growth that was essentially flat but still beat my gross margin expectations because the costs were so much lower than what I was expecting. So that's certainly a good sign. And I think I would rather see that than like slightly more aggressive top line growth, because we already know the pipeline's so strong. The fact that like we might need to start revising our energy margins upward if they can do this high of a margin with, you know, essentially flat deployments. It's
Any
a
other
very good sign the
thoughts?
more I'm thinking about it.
Yeah, I agree.
Yeah, and that line of in the energy storage paragraph, they say the ramp of this 40 gigawatt hour mega factory, the first of many, has been successful with still more room to reach full capacity.
What page?
This is page 9. And then they say, while energy storage deployment rate can be volatile to a project timing, production rate improved further sequentially in Q2. So they talked a little bit about why perhaps they might have had a little bit of a bumpy quarter for energy revenues.
Yeah.
And then just a question for you, Matt. How does the margin work? Are they basically dividing the revenue recognized this quarter by the cost of manufacturing for this quarter? Like, how does the revenue recognition and the manufacturing, like the delay in those two things, affect margin?
So any mega pack that they built, let's say they built a mega pack a year ago and it just got deployed this quarter, so it's like the revenues recognized this quarter. The costs that they incurred a year ago to make that mega pack, they got put into inventory at the time on the balance sheet. And then once the revenue is recognized, those costs come out of inventory and they go into cost of goods sold. So any revenue recognized for a particular project reflects more like the historic cost basis and, you know, and pricing that was there. It's not necessarily an accurate reflection of exactly what is the profitability of the Lathrop factory today, because things are locked. The costs are locked in with the time of the product that was built.
Let us know if you're seeing anything else. Nico, I see you published a link in the private chat. Is that
Yeah,
something
that's CNBC's title, just as we were talking about it. But
Oh, okay.
I know we're all talking about numbers here. I'm going to be the child here. If you look at the report and go down to the pictures, there's one where the Cybertruck is covered in mud. And I kind of feel like this is a shot to Jim Farley. They label it Cybertruck, built to do real work.
Oh, totally. Yeah, if you're not familiar, Farley was out there saying that, you know, this car, the F-150 is built for like real people. You know what's even more interesting? We can see the radius of the wiper. It's like this portion of the windshield is not being wiped unless there's like something else going on. I find that interesting.
Point.
I think so. We'll see.